This episode of Macro Mondays aired live at 12:30pm on Monday the 2nd of December. Tune in Mondays 12:30pm UK time to watch Macro Mondays live.
Hello and welcome to another Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, looking to give you insight from our trading floor.
Today, amongst the charts, risks and trends we'll be looking at, we'll look at the US yield curve. 10-year yields are trending back down again. And we'll also look at the US housing market. We've had more weak data out last week. We'll ask, is that a possible black swan event for 2025?
Chinese bond yields have been making multi-decade lows. We'll analyse some of the weakness in the Far East. And we'll also be looking ahead to the key payroll data coming out this Friday.
First to last week's data, and US consumer confidence has risen to 18-month highs. That's 16-month highs, surging to 111.7 from 108.7. And with that, we've seen stock market optimism soaring to record levels. If we look at the S&P, we can see it's now closed comfortably above 6,000 and it's trending higher. We've said many times recently that looking at the data historically, it's expensive. PE ratios, price to sales ratios, but it's trending higher. And that is the main arbiter of P&L. It's going up.
Absolutely. You know, we've been, not to beat a dead horse, but we've been saying there's a serious lack of coordination between equities in the US versus the underlying. And we'll come on to discuss some of the underlying warning signs in the US. But for all that you can be, you know, skeptical about potential growth to come and the housing market in the US, it's undeniable that equities have been performing and they're, you know, very much trending upwards.
And you can see from the chart, it's cleared the key level of 6,000. So what that does, as it breaks high, you get more money flowing in. So if anything, that's a really positive signal. If we look elsewhere at the data, PCE inflation, the Fed's key favorite metric, that came in largely as expected. But over the weekend, we see US Black Friday online sales hit a record $10.8 billion. So the consumer is still spending, whether it's on credit, they are still spending. And if we look at the regional data, we're getting some pretty mixed signals there. Chicago PMI actually came in at 40.2, forecast at 45. That's a really weak contraction signal. But then Dallas Fed Services Index rose sharply in November, now at the strongest level since March 2022. So mixed signals around the country from the PMIs. And actually we get the US manufacturing PMI coming out today and US services PMI coming out on Wednesday. So we'll get a better gauge, really the biggest week as well for US data. And on to housing, US new home sales fell 17.3%. That's pretty catastrophic month on month, estimated to fall just 1.8%. And it's looking like new home sales are on for the worst year since 1995. And contrast that with homes for sale, this continues to trend higher. So supply is going up, demand is falling, and we have mortgage rates at 6.84%. Again, this could be a big black swan event for 2025. It's not an event for this week or next week. It takes time to play out. But again, typically when unemployment goes up and people are forced to sell houses, that's when the property market starts to fall.
Yeah, so I think it's clear to see, you know, short-term optimism seems to be warranted. Fantastic figures on online sales, etc., for Black Friday. But you know, when you look at the disposable income available to low and medium income consumers, if they are foregoing things like housing purchases due to tightening of credit conditions or you know, an inability to afford new housing, I don't think it should necessarily be surprising that they're going to be substituting some of their consumption away from more expensive capital expenditure, i.e. housing, into things like Black Friday sales, the things that will give them a short burst of improving quality of life in a relatively, comparatively inexpensive method is relatively unsurprising. And then when you look at the housing, I think things are, very much worrying, and people should be worried. Insurance premiums I've been bleating on about for a few months now, they're through the roof. If you look at Florida, if you look at California. So I think we could be seeing a real issue in US housing going into the next year.
And also with Friday's payroll, we know that people taking second and third jobs is at record levels. That's not a good sign for a strong consumer. And also, while we're discussing the US is now running a historic deficit, 6.3% of GDP. This is the highest level it's been outside of World War II, financial crisis, or COVID. Scott Bessent's vowed to address the budget deficit, but again, this is what's really stimulating the US economy. Again, going back to payrolls, we can see the last few months, that's been driven by public payrolls, government hires as opposed to private. Again, Scott Bessent, he's the new Treasury Secretary. Another headache he's going to have is that US debt refinancing looms in 2025. And this, of course, is going to be at much more expensive levels. Onto the dollar. Spiked over the weekend. It was falling last week with US yields coming down. Spiked over the weekend on Donald Trump's comments vowing to put tariffs of 100% onto the BRICS countries if they were to try and take out a new currency. So the BRICS, Brazil, Russia, India, China, South Africa. Last year as well, joined by Iran, UAE, Ethiopia and Egypt. And Saudi Arabia, for instance, has done an 83 billion Chinese yuan energy contract. So Donald Trump's concerns they're moving away from the dollar. Again, it's a threat, isn't it?
Yeah, I don't think these are needless words as well. I think there has been growing sentiment against US dollar, against greenback hegemony worldwide. And, we at Onyx deal obviously in oil a lot. This term, the petrodollar, is never normally, it's not something that's formally enforced, having oil absolutely necessarily being purchased in dollar denominations, but it is ubiquitous. It's common practice, and if you look at who the significant players are worldwide in the oil scene, well, the US is definitely one of them, but they only make up a percentage of global oil production and global oil demand. So we've been seeing these BRICS summits moving away, and if you're active on Twitter or X, you will see time after time people saying that there's going to be a new BRICS currency. And I'm not surprised that Trump has tried to come out immediately. One of the first things before his presidency has actually even started and said, no, you cannot do that. Or if you do, you will face 100% tariffs. So I think it's understandable why he's saying this, and it's probably shows, really indicates the level of the concern in the US about breakaway BRICS.
Yep, absolutely. And with that, Brazilian reals dropped to a new all-time low against the dollar, and the Russian rubles imploding down one day last week, 6.7% against the dollar. And if you look at the chart we have here, this is a really interesting chart. It shows the correlation between the dollar and the US 10-year yield. The dollar is orange. It's had a huge move higher. Of course, the algorithms get on board, trend following. And with yields starting to tick lower, that's coming down. So if we're going to get a short-term sell-off in the dollar, where's that money going to go? Well, we're not fans of the euro. We'll come to that, some data there. Of course, what's benefiting at the moment is the yen, the Japanese yen. So the OIS market is pricing 50 basis points of hikes over the next year and 15 basis points of hikes at the meeting in December 19th. So the yen strengthening, dollar yen on Friday night closed below 150. And that seems to be a reverse, of course, of what we saw the first half of the year was dollar yen strength.
Yeah, with the carry trade, yeah. And then, just to build upon, the Trump tariff rhetoric, we had the headline come out this morning or Sunday evening, saying Canadian Prime Minister Justin Trudeau has promised President-elect Donald Trump that Canada would toughen controls over the long undefended joint border. And I think the significance of this headline is quite clear. There'd been some discussions and some rhetoric used by Trump, basically saying to both the northern and southern borders of the US that you guys need to tighten up your borders. Number one, to stop illegal immigration, but number two, to stop the inflow of illegal drugs into the US, particularly fentanyl into the US. So the context for Trudeau making this statement is. I think he sees these tariff threats that Trump has given as sincere, and so they are going to be working on doing this in order to avoid more tariffs. So, the kid with matches, Donald Trump, and threatening his tariff uses, I think people are taking this very, very seriously.
It's getting noticed. People are taking action. On to China. We had some data out over the weekend, mixed data out of China. Key point, though, is bond yields are not impressed, and they're now at multi-decade lows. So we had November PMIs coming out, manufacturing ticked just above expected, coming in at 50.3, expected 50.2, just showing signs of expansion. But Chinese home sales drop again. We're seeing actually Shanghai's vowed to distribute consumption vouchers to boost the economy. So now they're starting to address consumption, but the yields now, looking at the sovereign bond yields falling below 2%, that's the lowest it's been in more than 2 decades. While if we look at the next chart, Japan's 2-year bond yield has climbed to 6.25. That's the highest level in 13 years. And you can see from this chart here, the 30-year bonds, China's fallen below 2%, Japan's above 2%. They've crossed over. These are pretty strong signals. One economy is clearly struggling, the other economy is growing.
Yeah, absolutely. And I think, picking up particularly on the Shanghai consumption vouchers, it just seems as though China is committed at the moment to really pushing out this stimulus. And whilst that might provide temporary relief to the Chinese economy, I think a lot of people are seeing this as a worrying sign overall. If they're going to be continually relying for short-term support from stimulus packages, that's not a great sign for the economy long run, is it?
And again, if private investment is over 70% of that is in property, and property continues to fall, people are not going to spend. Also going back to China, record monthly outflows from major Chinese ETFs. Again, this is going to be another concerning signal to the PBOC after the bazooka stimulus we had back in, was it September now?
Yeah, must have been.
Yeah, that's completely worn off now, and investors are fleeing ETFs. On to copper, Dr. Copper. It's called Dr. Copper because it's seen as a signal to the global economy. It's the metal most used in industrial production and seen as a leading indicator to GDP. Well, it's sitting on a huge trend line here. It's still above the previous low, but again, if it breaks below that trend line, again, you're going to see stops triggered. You're going to see more selling coming into the market. Right now, it's not a positive signal for the global GDP. We'd need to see that turn up, see demand coming into copper for that to be seen as a positive.
I mean, absolutely. And for all that trend lines, that they can be a fantastic tool, and a lot of, you shouldn't disregard them as well, because a lot of people will pay significant attention to this, and there'll be managed money that will be paying attention to these new lows. But I think it's important just to look at the underlying and take a view yourself. If you're looking at this situation, hearing about issues in manufacturing in the Far East, issues in manufacturing in Europe, I think it would be understandable to expect that there could be a breakout to the downside. And if it does, then you could see quite dramatic price action to the downside.
Absolutely. And on to Bitcoin, trading at 95,250. Probably the bigger news over the weekend, XRP has surged 30% to become the 3rd largest cryptocurrency by market cap. But the chart we have here is Bitcoin. We've had a huge move higher. Now we're in a consolidation. We're down 2.5% on the day, which sounds a lot, but after the recent move, it's just still consolidation.
Yeah, and we said last week, I'm not overly surprised that it hasn't surpassed $100,000. You know, it's a number that a lot of people will like to get short at if it does flirt even more with that number. But to see this consolidation period between about $92,000 and $100,000, or just shy of $100,000, is probably, you know, as a sign of significant comfort to a lot of people. What I would say though is, if it's trading within an $8,000 range and we're seeing this as a consolidatory period, that's quite high, you know, that's high volatility. So some people may not like it, some money managers may not be able to hold it, but it is crypto. It's inherently volatile. So I could see it staying in this range for a good while now.
And another good point from a trading perspective, if it closes above 100,000, then new money will rush into it.
Absolutely.
And the previous move was about 28,000, was it about 72?
70, yeah, let's just call it 73,000 or whatever.
So that would imply the next target will be around 125,000. These are big moves, but as you say, it's crypto, it's volatile.
Absolutely.
And onto the German data last week. October retail sales fell 1.5%, much worse than expected, 0.3% fall. And IFO, business climate, current conditions and expectations all fell. ECB's, the Eurozone November CPI, that came in, it bounced to 2.3%. That was as expected, but it is now back above the ECB's core level, their target. So we had Isabel Schwabel warned in an interview with Bloomberg, her colleagues should be wary of cutting rates too far. You can see from the chart here, though, Eurozone composite PMIs, they're weak across the board, particularly the two big countries in the Eurozone, Germany and France. And you can see just how a big an impact the Olympics had in France. That's now history, and it's pretty bleak.
It's bad. And, you know, we'll now take a look as well at the German power futures. Taking this, I mean, it's not a perfect proxy for German manufacturing or European manufacturing, but there's a high degree of correlation between the two. One is used for the other. And we've been seeing manufacturing weakness for months now in Germany. Last week, we had the headlines about the automotive industry, the jobs there. I think, you know, 30,000 jobs perhaps being cut from Volkswagen, etc. So the things seem to be rather disjointed, and we've seen power futures actually trending higher. I think it's not of particular surprise to anyone here that we've seen this softening, and directionally on that basis, I would expect this to trend further down. You may see some noise in the meantime, as you know, a headline here or there can shake things around, but directionally, manufacturing in Europe looks really dire.
On that, I was reading just this morning about electric car vehicles, German electric car vehicles in China in October. The Audi e-tron, there were 0 sales. November 2023, 876. That's a pretty big collapse, can't go any lower. And Mercedes EQE, 971 sales in Jan 2023, 0 in October 2024.
I think if you were to look the other way around and look at BYD sales in Europe, you'd be seeing the absolute opposite. Yeah. So it seems as though things are shifting away from European manufacturing, especially on the car side of things.
They're far cheaper and they're great quality.
Yeah.
And for the first time in history, French bond yields, actually this morning, they're trading above Greek yields. French bond futures are lower amid political tensions. Again, just this morning, Marine Le Pen has vowed to bring down the French government, and Polymarket is now trading at 74% chance that Michael Barnier, the Prime Minister, will be ousted by the end of this month.
Yeah, I think this is one of those where if you'd have been in a coma since 2010 and been saying that France and Greece were trading on parity with each other, you'd have asked to be put back into the coma, I'm
Unbelievable,
sure. But,
yeah. And again, we said looking at the yields that the dollar should be trending lower, but certainly not against the euro. I think the euro is definitely one way here. Parity is being targeted. But again, the trade to do in the currency world, if these are your views, is to sell euro yen, because we're seeing, as we said,
support in Japan. And
absolutely. More dovish ECB chatter over the weekend. ECB's Lane said monetary policy remains restrictive and inflation will be sustainably at 2% in 2025. And ECB's Kazak said in an interview that rate reductions must continue. The chart here shows euro dollar. The yellow line's the 8-day moving average. Even though we had a pullback last week, it's still trending down. Again, parity has to be the target here.
Yeah, just to talk about Brent for a moment here. So we've been seeing, volatility continue to come down in Brent. We're very much in this period of convergence here. There seems to be key support around the $70.50 sort of range. Occasionally it eclipses that, but it seems to bounce back. And we're very much in a low vol period at the moment. But I suppose, just to touch upon the price action over the previous week, the major headline was that there was this ceasefire between Lebanon and Israel has been announced. So that came into effect Tuesday morning. I think it was 4 a.m. local time. It seems to have been adhered to thus far. And this has had a slightly, very slightly suppressionary price impact upon Brent prices. But we seem to be sort of stuck here. And one thing that is worth noting is in oil, in trading in general, you can enter low periods of volatility just because people don't really want to strap risk on. We're entering, the final bit of Q4. I think it's not silly to point out that a lot of people will have either made their money thus far or will have been basically stopped out of most of their positions. So you may not see that much risk strapped on in the remaining month of Q4. And so to see significant price impacts, I think at this point would probably rely on headlines.
Absolutely. Gold last week had its biggest one-day fall since January 2021, down 3.4% on the day. And as you can see, again, a consolidation here. We've had a big move up. It's consolidating. Key support is at 3,550. Again, which way is it going to go? I don't know. It depends. And you made a great point, a valid point. Even if you haven't made your money for the year, typically you would be told to run down your positions and not have any volatile P&L swings into the end of the month, end of the year.
Totally. And, gold was being highly, it was being punted on pre-US election a lot. That's a known entity now. I can see this kind of just pattering along a bit for the remainder of the year.
Yeah, money's back into equities, money's back into Bitcoin, so the interest has disappeared slightly.
Totally.
Last week, central banks, we had the RBNZ cut 50 basis points. The market was looking at a chance of 75 there. And Bank of Korea unexpectedly cut 25 basis points. A few other markets, orange juice hit all-time highs and Arabica coffee, the expensive stuff, hit highest price since 1997.
Yeah, it's the breakfast trade, isn't it? Orange juice and coffee.
So central bank pricing for the next 12 months. We have a few central bank meetings coming up. The Fed on the 18th of December, the market's pricing 15 basis points of cuts. So just over 50-50, the market's looking for a cut. ECB on the 12th, the market's looking for 31 basis points of cuts. Again, they're either going to do 25 or 50. The market's not convinced which yet. The Swiss franc, we have the SMB, or we have, I should say, CPI coming out tomorrow. But the market in Switzerland is pricing 99 basis points of cuts over the next year. And that's now pricing OIS at negative. So the market's now pricing terminal rates in Switzerland in a year's time at -8 basis points. Again, very different to what's going on in the US market.
Totally. But I think Europe needs to be proactive, and the Swiss government, Swiss central bank is often seen to be as the most active in these. So,
and also to, I was going to say, defend the currency. The currency is incredibly strong because the euro is so weak. Yeah. So again, they're forced for their trade purposes. One other one there as well, Bank of Japan on the 19th of December. I mentioned earlier, the market's pricing, expecting 15 basis points of hikes. Interesting chart to look at, Nvidia. The uptrend here is at risk. Important point here is the semiconductor ETF is trading 20% below its peak. So that is now clearly trending down. And you can see here, key level, the previous high in NVIDIA, 141. It's below that. If it starts trending down from here, we'll see market money starting to exit that pretty quickly. That's definitely a crowded trade. And final chart here, the final slide, we have payrolls this week in the US. The key data, the market's expecting 200,000 new jobs created and the unemployment rate to remain at 4.1%. And you can see the payrolls in black here, but you can see pretty highly correlated with the Kansas City Fed employment, and that's trending aggressively higher here. So it looks to me, if anything, the unemployment rate is going to start ticking higher. And again, we said this before, when the economy slows, it trends.
Yeah, absolutely. And I'd be interested to see, you know, in a year's time as well. We've been critiquing payroll data for being very much led by the public sector. And if you're going to be getting this new Department of Government Efficiency looking to slice jobs in the public sector, perhaps you might see these reported levels of unemployment continuing to be quite high in the US.
Again, also one problem with payroll data is the constant revisions that we're seeing. So I'm seeing more and more people talking about the importance of the JOLTS data, job openings, which comes out on Tuesday. So the data we have this week, on Monday, as we said earlier, ISM manufacturing PMIs. On Tuesday, JOLTS job openings data. Wednesday's ADP employment data, ISM services, and Fed's Chairman Powell is speaking. Thursday, initial jobless claims, and then the big one on Friday, November jobs report, payrolls, and also University of Michigan consumer confidence. So we have a big week of data ahead. We have some pretty volatile moves in some markets. Good luck, and we'll see you next week. Thank you very much.
Thank you.